Welcome back to another episode of Financial Market Insights for Traders, where we break down complex financial topics into easy to understand insights for traders and investors. I'm Sophia, and today we're diving into one of the most exciting and fast paced aspects of trading: economic news trading. Whether you're a Forex trader, stock market enthusiast, or a commodity investor, economic news releases provide some of the biggest opportunities to capitalize on volatility if you know how to trade them correctly. Now, why is economic news so powerful? Think about it. Central banks making interest rate decisions, governments releasing employment data, inflation reports, or GDP growth numbers. These are fundamental drivers of financial markets. A single announcement can send currencies soaring, stocks crashing, and commodities swinging wildly. The question is, how do you position yourself to benefit from these market-moving events without getting caught in the chaos? In this episode, we'll cover what economic news trading is and why it matters, the most important economic indicators that impact markets, proven strategies for trading economic news successfully, risk management techniques to protect your capital, common mistakes traders make when trading news, and how to avoid them. Understanding economic news trading. Economic news trading is all about anticipating market reactions to key financial reports and central bank decisions. Traders analyze the economic calendar, forecast how the market will react, and execute trades based on the data released. The financial world pays close attention to these releases because they provide valuable insight into a country's economic health, guiding investment decisions for hedge funds, banks, and retail traders alike. For example, let's say the U.S. releases its monthly non-farm payrolls, NFP, report, a major economic indicator that measures employment growth. If the number of jobs added is much higher than expected, it signals a strong economy, possibly leading to a rise in the U.S. dollar and stock markets. On the flip side, a weaker than expected jobs report could send the dollar lower and create uncertainty in equity markets. Key economic indicators that move markets. While there are hundreds of economic data releases, not all of them create significant market movement. Here are the top economic indicators that every trader should watch. Gross domestic product (GDP) measures a country's total economic output. A strong GDP report suggests economic growth, boosting the local currency and stock markets. Non-farm payrolls (NFP), unemployment rate, a vital report for Forex and stock traders. Strong job creation usually strengthens the country's currency, while high unemployment can weaken it. Consumer Price Index (CPI), inflation data. Inflation reports influence central bank decisions. High inflation might lead to interest rate hikes, strengthening the currency. Interest rate decisions. Central banks like the Federal Reserve and European Central Bank set interest rates. Higher rates attract foreign investment, strengthening the currency, while lower rates tend to weaken it. Retail sales consumer confidence measures consumer spending trends. Strong retail sales indicate economic strength, supporting equities and the local currency. Trade balance manufacturing (PMI). A country with a positive trade balance, more exports than imports, typically has a stronger currency. Strategies for trading economic news. Economic news trading requires precision and a well-defined strategy. Let's explore some of the most effective approaches traders use. 1. Straddle trading strategy. This method involves placing a buy stop order above the market price and a sell stop order below it before the news release. If the market moves sharply in one direction, the corresponding order is triggered while the other is canceled. This strategy is effective for trading high-impact news events like interest rate decisions and NFP reports. 2. Breakout trading strategy. In this approach, traders wait for the market to establish a clear direction after the news release. They enter trades once the price breaks key support or resistance levels. This helps traders avoid the initial volatility and capture strong post-news trends. 3. Fade the initial move. Markets often overreact to economic news. The fade strategy involves taking a position against the initial market reaction, expecting a correction. This is common in situations where a news release causes an exaggerated spike or dip in price. 4. Trend following strategy. Instead of trading the immediate reaction, some traders wait to see how the market digests the news over time. If the report aligns with the prevailing trend, they enter trades in the direction of the trend, riding the momentum. Risk management when trading economic news. Economic news trading is highly volatile, so risk management is crucial. Here are key steps to protect your capital. Use stop loss orders. Volatility can cause large price swings. Always set a stop loss to prevent significant losses. Reduce position size. Due to unpredictable market reactions, trading with a smaller position helps control risk. Avoid trading during low liquidity periods. Some news releases occur during low volume market hours, leading to erratic price movements. Diversify your trades. Spreading risk across different assets reduces exposure to a single economic event. Stay updated on market sentiment. Use financial news sources, economic calendars, and central bank statements to stay ahead of major announcements. Common mistakes to avoid. Even experienced traders make mistakes when trading economic news. Here are some pitfalls to watch out for. Overtrading, jumping into trades on every news event without a solid strategy, leads to excessive losses. Ignoring market expectations. Markets react not only to actual data, but also to how it compares to expectations. Always compare forecasts versus actual results. Trading without a plan. Impulse trading leads to poor decisions. Always have an entry and exit plan before a news event. Holding trades too long. Economic news often creates short-term spikes before reverting. Taking profits too late can result in unnecessary losses. Ignoring the bigger picture. News events are part of a larger economic cycle. Understanding the broader context helps in making informed trading decisions. Conclusion. Trading economic news can be highly rewarding when approached with the right strategy and risk management. By understanding key economic indicators, employing effective trading methods, and avoiding common mistakes, traders can capitalize on market volatility while protecting their capital. For real-time economic news updates and a seamless trading experience, check out crystalballmarkets.com. Their platform offers instant execution, low spreads, and tools to help you stay ahead of market-moving events. That's it for today's episode of Financial Insights. Stay informed, trade smart, and I'll catch you in the next episode. Until then, happy trading.